You're listening to Sprott Money's monthly wrap-up with Craig Hemke.
Welcome back to the Sprott Money News, SprottMoney.com monthly wrap-up for the month of April, the tumultuous month of April 2022. I'm your host, Craig Hemke. Joining us this month is Dave Kranzler. If you are in the precious metal sector, you probably know Dave. He runs a great website, investmentresearchdynamics.com, and his newsletter, the Mining Stock Journal, is really very valuable if you're interested in the mining sector. I mean, you can do your own research. Heck, you can even throw darts at a board. You're going to get some winners. But a lot of times the key is avoiding the losers. And Dave does great work and has been doing it for quite a long time. And personally, I would encourage you to check out his site again, investmentresearchdynamics.com. He's also an occasional writer here at Sprott Money. So it's great to have him join us for the monthly wrap-up. Dave, thank you so much for spending a few minutes with me.
Thanks for having me on, Craig. It's an honor to be invited, although I think your intro might have been a little over-complimentary.
If only they all knew you as I know you. But anyway, no, it is. I state this often. Again, I think we're in a pretty solid bull market here, regardless of what we've been through the last 6 or 7 days. And we'll talk about that. But you need help. I mean, you got guys like Eric that can do it on their own, but even he's got a team that helps him look at the mining shares to find which are the right ones. So you need a team. And I think what you do is very valuable in that regard, Dave. And again, I want to point out, as I often do, all information in the precious metals value. We really don't want to do it on your own. And I think what Sprott Money does, either with these calls, this monthly wrap up, or the monthly preview thing that I do with that looks at the technicals with Chris Bermulin, the articles that are written by great writers like David Brady, all this stuff is valuable. So please check out SprottMoney.com all the time. Sign up for the newsletter so that when something is posted, you don't miss out. Hit maybe a like and a subscribe on whichever media channel you take the stuff in so that you get notified as soon as stuff comes up. And then again, thank Sprott Money for this content. You know, they make it for free, but you know, it's a business. And so they could, it'd be great to have you put them on the list whenever you're in the market for physical metal or storage. And SprottMoney.com is the website. And of course, you can always call them at 888-861-0775. Dave. Okay. It has been a tumultuous month, man. Let's see, it took about 12 weeks for the GDX to go from 29 to 41, and it took 1 week to give half of that back. So let's start there. Just a correction, you know, where all the latecomers get flushed fast. What do you make of the mining shares here as the month ends?
You know, I like the way you put that, because what people tend to overlook is, and I had run the numbers right before the GDX fell. If you just look at the chart, it looks like it fell off a cliff. And I had run the numbers right before it fell off a cliff. And from the end of January through, let's just call it April 14th, I mean, it was up 30%. I mean, that's a huge move for a stock index in that short a period of time. I mean, if the S&P or the NASDAQ went up 30% in 2.5 months, I mean, they'd be doing naked cartwheels on CNBC over it.
Yep.
You know, of course, that type of move in the mining stock sector gets no acknowledgement except, you know, by we gold bugs. So I was actually expecting some type of correction or pullback. And, you know, as you point out, it took a week or week and a half to give back half of that gain. And that's just the way it rolls in this sector. It's the sell-offs are shock and awe, and the big moves higher get very little notice or recognition in the mainstream media. So, and I think it's obviously there's some correlation there with what's happened in the stock market, because you get, you know, hedge funds are, especially the momentum oriented ones, when they see they'll pile into anything that's moving higher. Right. And so, I'm assuming that especially some of these momentum based hedge funds had big positions in the ETFs. in a lot of the stocks. And when the stock market starts doing what it's done over the last week and a half, they sell everything. I mean, anything that's not nailed down in their office, they toss it out and hit bids, because they don't, first of all, because they're levered up, they don't want to get margin calls. And they're also trying to get out ahead of everyone else. So that was also a factor. And I had been writing in my newsletter for probably a month that, and again, I'm not a big TA trader, but you have to pay attention to what just the simple TA indicators are doing, like the RSI and the MACD. And they had gotten extremely overbought technically. Yeah. Mm-hmm. And I was talking about, we could use some type of sector correction just to reset the momentum indicators and get some of the froth out of the sector. And I mean, as usually happens, it happened all at once. So then I guess the issue is, does this keep on going for a lot longer, like sometimes it has in the past? Or do we, are we going to get a bounce here at some point? So, I would say maybe the worst this gets is GDX goes down to the 200-day moving average. I mean, when we have long, sustainable bull cyclical moves in this sector, and I think we're in one right now, usually the worst it gets when you have corrections is the 200-day moving average. So I'm probably going to start actually allocating some more of my capital slowly back into some of my favorite names. But I'm not going to jump in all at once, because I always advise my subscribers, save capital for a rainy day, because you never know, just how volatile this sector can get both ways.
Right. The rainy day rolls in pretty fast.
Yeah, exactly. It quickly becomes a downpour.
It sure does. And for everybody listening, the GDX about 35 as we record this. I think that 200 days down around 33. So that's 6-7%, maybe more down, which could come. We've got, and I want to focus on this, Dave, as we look ahead. We've got this May FOMC meeting coming next week. We're recording this on Wednesday, the 27th. It's just before 1 o'clock, 1 week Central, at least 1 week from right now. We'll be getting what I call the Fed lines, and then a half hour later, Powell's press conference. There are two angles to that I want to explore with you. And then we've got some questions that people have sent in.
Sure. One,
the stock market, really all markets, again, not just the mining sector. I mean, there were days last week when crude would be up and the energy sector would be down 3%. This kind of liquidation event that spilled over into futures, like you said, anything that's not nailed down starts getting sold to avoid margin calls. People try to tie that back to who I call Goon Bullard early last week, saying that he wants 75 basis points as soon as this Fed meeting next week. And some people tried to walk that back, but that kind of seemed to get things steamrolling to the downside. So as the first question I want to ask you, how much of this, and again, I have a follow-up to this, so I want to focus specifically on how much of this washback in shares, metals, S&P, everything else is related to this notion that the Fed is going to be really hawkish coming out of that meeting next week?
That's a great question, because I mean, there's obviously a lot of things going on beneath the surface, not related to Goon Bullard and his clan.
We'll get there. That's part two.
But it certainly you could say, I think what we saw in the stock market, at least, was probably going to happen anyway. But you could certainly say that Bullard's remarks were a trigger point. And also recall around the same time, Lael Brainerd came out and advocated higher interest rates, and
right.
And she's the the resident MMT economist on the FOMC committee. So I personally was shocked when I heard her talk about that, and I think it was kind of the Bullard Brainerd combo that was your trigger event.
And down we went, and it looked like we were okay until, what was it, Wednesday, I guess, last week, 1 week ago today, and okay, so now we approach it, and maybe that's all it is. But But you're an expert, Dave. You've been at this a long time, and your expertise in fixed income and derivatives and all the other knowledge and experience you've gained allows you to kind of peel back the onion a little bit more and maybe connect the dots. And what other metaphors can I come up with in the next 5 seconds? Okay. All right. So here's where I'm going with this. The Bank of Japan has had a policy of yield curve control in place for what, a decade more, where they don't allow the Japanese government bond to go above 25 basis points.
Yeah.
And so all of this hiking by the Fed and the 10-year note spiking up near to 10 or 3% and all this kind of stuff is putting huge pressure on the Bank of Japan to defend that yield curve control. So they're printing yen and buying Japanese government bonds like crazy. And the yen is just imploding. The move in the yen weaker versus the dollar is over 10% in just the last couple of months. Now that by extension is putting a lot of pressure on the Chinese, who have already been cutting rates while you've been hiking, and they can't seem to cut them any further, which then pressures the Chinese to devalue yuan. Now, last time they did that in 2015, the S&P fell 10% in 5 days. So I wonder, Dave, is there, and this is what I want to get people thinking about and get your thoughts on, is there this kind of a loop now that can close off, that by the Fed threatening to be hawkish and hiking rates puts all this other pressure around the planet, which then dries up liquidity, collapses markets, stock market starts to go down, and it completely cuts the Fed off at the knees, regardless of how hawkish they want to be?
So I guess what you're asking is, given what's going on with the Bank of Japan and the People's Bank of China, is that going to give the Fed some leeway to backpedal on its monetary policy?
I get, and the ECB too, Dave, because all they can, I mean, all the 9 trillion euro on their balance sheet, you start marking all that to market on higher interest rates, and they're going to all of a sudden be insolvent. So yes, that's what I'm at.
Central banks already are insolvent.
Good point.
I've had kind of in the back of my head, I've kind of had a working theory of really what we're just seeing is a competitive, it's a competition to devalue your currency, where eventually they're all going to devalue them to zero. But yeah, it does seem like these central banks, between China, I don't know about Japan because they haven't been hawkish at all in the last 10 or 15 years, but it seems like, one will make a move to either tighten or loosen, and then the others kind of follow suit. So yeah, you're right. I mean, you would think that relative to what's going on with the yuan and the yen and the euro, with what's going on with the dollar, maybe the Fed can say, oh well, maybe we can ease up on our monetary policy now that everyone else is. But that's not going to fix the inflation problem.
Right.
So I guess it kind of just depends on how serious they are about attacking the inflation problem, because quite frankly, Bullard's banging the chains for a 75 basis point hike. That's not going to do anything. I mean, they need, just to get, if you want to just use the CPI inflation rate, just to get to a neutral interest rate, you have to take it up to what, 8.5%.
Good luck with that.
Wasn't the CPI year over year 8.5% for March?
Yeah.
Yeah. So I mean, I don't, and that's why Volcker did what he did so abruptly eventually. Now, obviously, our clowns don't have room to do that, but I mean, nudging interest rates up to even 1%, that's not gonna do a lot. I mean, yeah, it'll slow down the economy, and you might put a brake on prices with demand destruction, but you still have massively negative interest rates, and so just by that you're de facto devaluing the currency.
So in the end, Dave, we'll listen to the Fed next week, and it doesn't matter, right? I mean, because the people listening to us are mainly precious metals enthusiasts, right? They watch the price go up and down. They watch the shares go up and down. And you got to pay attention, right? And if you want to try to time things or do whatever, but does it really matter? I mean, is it all kind of this kind of doom loop at this point anyway? And the central banks are trapped, and there's really no way out other than MMT and money printing. And so therefore, I would just love the weakness and when it comes and buy more.
Well, I think that's right. I don't know what else you're going to do. I mean, if you're trying to buy, now the big narrative is, oh, well, rotate into defensive stocks, right?
Right.
Like consumer staples and defense companies and pharmaceuticals or whatever. Well, that's great. And maybe they go down more slowly relative to the rest of the market. I don't know. Or maybe they catch a bid and move higher as money rotates into that. But when you sell that, you still end up with dollars in your account that are being devalued every second. So what's the point?
Right. Exactly. Hey, great. I've got dollars again. Lucky me.
That's right. I mean, for me, I know, I only move money. I only buy more physical gold and silver when they get really, really beat up. So like right now, I'm not really thinking about buying any more gold and silver physical at this point. I think there's still more money to be made in the stocks, but so like in March and April 2020, I started buying some physical gold and silver again, and we were down at gold got as low as 1,200. I didn't get ounces of gold that low, but I know that the $1,200 that I moved into each ounce of gold, or 1,250 or 1,300, whatever the number is. Now, if I wanted to sell it, I'd be getting almost $2,000 for it when you include the premium, 1,950. So I'd actually be getting a lot more in fiat currency. And so to me, that's how gold is supposed to function. It preserves your wealth. And when it gets undervalued, and same with silver, I don't want to leave silver out. I mean, when I mention gold, it also means silver. I own more silver than I do gold. That's the way gold and silver is supposed to function. They preserve your wealth. But when they get to be ridiculously cheap, and I do think they are ridiculously cheap right now, but I mean, I've got a lot. So I want to wait and see if it gets even cheaper before I buy more. Then it also becomes an investment because there's some rate of return opportunity in there also.
Right. Well, all right, my friend, when we announced you were going to be the guest this month, we had a number of questions get sent in. And whenever we do these calls, we always take questions ahead of time. The email address is just the word submissions at sprottmoney.com. Just as we wrap up, Dave, just 4 quickies for you, just to kind of get your thought. I wanted to just get your thoughts and see if we can answer some of these. You mentioned physical silver, and kind of, sometimes it's a good trade, and there are various avenues to do that. People have heard me rail against the major ETFs, like the SLV and the GLD. I think those are a sham. But PSLV and PHYS, as managed by Sprott Asset Management, are just fine. Great physical metal. Backing those. So anyway, the question, Dave, was somebody wanted to get your opinion on using PSLV instead of physical metal for stacking purposes, exposure to price. That's maybe there's a tax benefit when it comes to sell as capital gains. Rather, I'm not sure exactly how it's treated in Canada. Just your thoughts on PSLV.
Sure. Well, I mean, what differentiates the Sprott ETFs from the other ETFs is that there's obviously a much more rigid accountability mechanism, so that that when you're buying the share of PSLV, that the silver is actually in the vault to back that share, right?
Right. Yep.
And it has a convertibility mechanism. Now, I mean, for a lot of people, that convertibility mechanism may be out of reach financially, but that's also an accountability mechanism. The fact that a high net worth guy, if they buy enough PSLV, they can. Well, I don't think they call you up. They'll call up Eric. They say, "Hey, Eric, I want to send you my PSLV certificates. Send me my silver." And that happens. Theoretically, it's supposed to happen with GLD and SLV, but it doesn't. And I've heard horror stories from people who are in a position to know, and I don't want to, say who they are, but they've heard, periodically of wealthy guys trying to trying to redeem their GLD shares for 400-ounce bars, and they get denied.
Right.
So, yeah, I mean, I don't look at PSLV as an exact substitute for stacking silver, but for convenience and for indexing the price of silver, and also for being certain that when we do have that big default event and the straw man ETFs head south while the price of gold and silver head north, PSLV and Fizz are going to head north also, because they are in a bona fide manner backed by actual physical gold and silver, and there's accountability there.
Yep. Yeah, that's a good lead in to a question I want to make sure I ask you, because we had 2 or 3 people kind of give variations of this question. It just gets back to the old gold silver ratio. Somebody mentions here that Eric suggested, return the old bimetallic ratio of 15-1. I don't even know what to make of it anymore, because everything's so levered and it's all derivatives, and maybe it's a gold silver derivative ratio. But what do you think? I mean, what do you think of the gold silver ratio, and do you use it in asset allocation, and where do you think it might go to when things finally shake out?
Well, the simple answer is I think the gold silver ratio is way too high right now.
There you go.
To me, that's your best relative value gauge, maybe in the whole market, because I think gold and silver are extraordinarily cheap relative to any other type of financial asset that's available. And I think silver is extraordinarily cheap to gold. And Eric's right. I mean, there's been certain times when the gold silver ratio has reverted back to 16, and times of extreme duress. So 1929, gold silver ratio was 16. And in fact, I think the Dow gold ratio went to 1 briefly. And when we had that big run up in 1980, gold silver ratio, I believe, I think I just calculated the other day, it was at 16.
16, yeah.
Yeah. And the Dow gold ratio was at 1 briefly. So we didn't quite see that in 2008, but 2008 to 2011, but the gold silver ratio did get down to, I think, 30, as low as 30 or low 30s. And part of that reason I attribute that to is because the Fed acted so quickly at dumping money into the system to save the banks. And the same thing happened in March 2020. The Fed acted even more quickly and dumped even more money in all at once. And so that distorted historical ratios, with the Dow gold and the gold silver ratio. But yeah, I mean, I obviously my view is that I think our financial markets at some point here are going to fall apart uncontrollably. And at that point, I think will the gold silver ratio get down to 16? I don't know, but I think it at least gets cut in half from where it is right now. So I think it's a very useful indicator to if you're judging whether you should be buying physical gold or physical silver, well, which one do I buy? Well, where's the gold silver ratio? It's at 80 now. Well, then I'm gonna maybe I'll buy a little bit of gold, but I'm going to buy a lot of silver.
Yeah. Here's a question, Dave, that kind of gets to your experience with the mining shares, and it concerns buyouts. How many acquisitions would a major or a mid-tier miner conduct in a cycle? Do they generally pay for their acquisitions relative to their market cap? I mean, how big of an app bite can you take of the apple? And is that something that we should expect more of, because they've already been increasing dividends and share buybacks and things like that?
Yeah, I don't think there's anything formulaic about how many mid cap, small cap, and juniors do the large cap guys swallow. But yeah, up until I don't know the last few weeks, we were starting to see a fair amount of acquisition activity in the sector. And actually, Kinross over the last couple of weeks, they unloaded their Russian mines.
Yeah.
If you remember the old Bima Gold back in the early 2000s, that was one of their Russian mines, was Bima Gold. I used to own Bima Gold. And then they just sold a mine in Ghana to I think it's called like Asante Gold. I actually want to take a look at this company. Yeah, Asante Gold. They sold a mine to Asante Gold, which is a junior, and I took a look at what they bought, and I was like, oh, this might be cheap. So, and obviously the two big acquisitions were Kinross buying Great Bear, and Agnico Eagle buying Kirkland Lake, and I think once Agnico Eagle gets Kirkland Lake digested, I think they're going to be on the acquisition trail again. So, and the hot areas that I'm looking at for acquisition possibilities would obviously be northeastern Canada, possibly British Columbia, Nevada, maybe Mexico. I think some people are getting frightened away by what seems to be more rigid anti-mining standards being imposed there, but I think that's more talk than reality. And then, believe it or not, West Africa. I think West Africa is extraordinarily cheap right now, or undervalued. And so, I think once things stabilize again and we start heading higher, and especially if gold holds over 1900 and silver can get into the high 20s and stay there and move higher from there, I think you're going to see M&A activity pick up a lot.
All right. One last question, Dave, because I know this stock's been in the news, and someone sent this in, wanted me to ask you. It comes up often at my TF Metals report site too, but what do you think of this Pure Gold deal? I know Eric's financing company floated them some cash here recently to kind of keep them afloat. What are your thoughts on it?
Well, if I share my thoughts, I'm going to be front running my subscribers who will get my thoughts tomorrow afternoon. I can comment on it because I've been writing about it a lot lately. I've actually followed Pure Gold, and I first invested in it in the summer of 2016 at like 30 cents. And so I know the company pretty well, and I've ridden with it through the ups and downs. And I mean, when they issued their mea culpa at the end of March about what was wrong with the mine operation, I mean, unless you were on the inside of that company, you had no idea. And I've spent a lot of time talking with the company about it, and I'm convinced that it is going to be a successful turnaround situation. I am convinced of that. And, I think Sprott is probably convinced of that too, because Sprott Resources gave them the waiver on their debt payment, and they made a $6 million credit facility available to them to give them some liquidity. And my understanding is, I think Eric's going to participate in the equity offering that they're out there with, and I'm pretty sure Anglo Gold is going to. And it's unfortunate because I know my average cost is much higher than where it's trading now, and I was recommending it at much higher prices. But I think now is an opportunity, if you invest in it, to get a lot of your money back and to average down and maybe eventually make some money. I mean, it's not a problem with the asset itself. It's not a problem with the deposit. It's not a problem with the metallurgy. Everything that they ran into had to do with human error, and those errors were magnified by the COVID lockdown situation when they were in the startup phase. So, I mean, I've actually intermittently over the last couple of weeks, I've been adding to my position down here. I've got some as low as 12 cents in US dollars. And I was going to buy some more yesterday if the entire stock market wasn't digging for China. So I think if you assume that, our markets aren't going to completely melt down and that the precious metal sector is going much higher, this is one of the better risk return plays out there. And I think there's a lot of upside in the stock potentially.
Well, I think you've just exposed the value of what you do. So please, as we wrap up, Dave, tell everybody again, you go to investmentresearchdynamics.com and look to sign up for the newsletter.
Well, there's links there to my mining stock journal and my short sellers journal. And if you click on the link, you can get some information about what's involved. And I don't have a minimum subscription period requirement. So that's how it works.
Awesome.
I probably should, but I don't.
Well, again, Dave, thank you. We've been speaking with Dave Kranzler, the publisher of the Mining Stock Journal. All around good guy, and I think is probably something that everybody's enjoyed listening to. Again, on your way out, please be sure to thank Sprott Money for this content. You can do something as simple as a like or a subscribe to whatever platform you listen to, or of course visit their site. I mean, prices are certainly on sale versus where they were about 2 weeks ago. And the old adage at my side is you always got to be ready to sell some when things look the most rosy and buy some when things look the worst. I'm not sure we're maybe at the worst yet, but certainly not as rosy as it was a couple of weeks ago. SprottMoney.com, great deals on physical precious metal and storing that metal if you want a safe, secure place to put it. Please be sure to check them out and give them a call at 888-861-0775. Dave Kranzler, thank you so much for your time. I've kept you longer than I promised, but it's valuable stuff. I really appreciate it.
Thanks for having me on again, Craig. I appreciate it. Good talking with you.
It's always fun to talk to you too. And from all of us at Sprott Money News and SprottMoney.com, thank you for listening. We'll see what the month of May has in store for us.